Hi, Michael Yarden here and welcome to another Ask the Experts webcast. Today I've got with me Brett Warren, Senior Property Strategist of Metropole in Brisbane. Welcome, Brett.
Good morning, Michael. Welcome. Thanks very much.
What I'd like to talk about today, Brett, is the investment mistakes you see people make investing in Brisbane or in southeast Queensland in general. You've been a property strategist for a long time and an investor for much longer and working with the Metropole team for close to a decade now. So Brett, what are the common mistakes you see investors make?
Yeah, thanks, Michael. Look, it's probably quite common in most places, but the first one is there's too much exposure in their own backyard in southeast Queensland. So they think by diversifying their portfolio, it means maybe Brisbane, Gold Coast, Townsville, something like that. But that's probably clearly not diversifying enough.
Well, diversification in my mind is leading to averageness, which is bottom of the best and best of the bottom, which potentially isn't the right way of doing things. I know Warren Buffett said diversification is for people who don't understand what's going on. Now, if you find some good areas in Brisbane, to diversify to secondary locations doesn't make a lot of sense. But then again, if you have exposure to some of the big property markets around Australia, that makes some sense. So what you're saying is everything in southeast Queensland, especially over the last 5 to 10 years, probably hasn't been a good investment strategy. Having said that, most Queensland people are wondering, well, I don't know Sydney, I don't know Melbourne, what should I do? What would your advice to them be?
Yeah, absolutely. Look, they need to seek professional help. It's almost like you're learning to drive a car or something like that. You just don't go and try yourself. You seek a professional out. You treat your portfolio like a business, and you learn from people who are doing it, and being successful at the same time.
Interestingly, when they do that, sometimes they're not sure who to ask because not everyone who's in Brisbane understands the Melbourne or Sydney property market. In fact, it's one of the things that I know you see, and we sometimes joke about how the interstate buyers agents fly up to Brisbane, make 5 offers, go home and have bought one property, and you sort of laugh and think, I would have never bought there, I would have never bought that. You need on-the-ground experience if you're going to go elsewhere. And I know that you often refer your clients from Brisbane to Melbourne and Sydney because we've got our own teams on the ground here.
Yeah, look, most definitely. And look, Michael, I've got extensive knowledge of property as well. And if I was looking to buy in a different market, such as Sydney and Melbourne, I definitely would be seeking professional help, even though I, to some extent, know what I'm kind of looking for. But as you said, it's that context on the ground and knowing the good areas from the bad areas and things like that.
Interestingly, you can do a lot of homework on the internet. There's so much research available now. What you lack is the perspective, the information of why one street is better than the other or one side of the street is better than the other. And you can't get that from the internet, and you can only get that from years of experience and, unfortunately, making mistakes along the way in a learning fee. So the first mistake that you mentioned, Brett, that many investors make is being too concentrated in southeast Queensland. What's another common mistake you see Brisbane investors making?
Yeah, absolutely. Look, we all make mistakes, Michael. I've been in portfolio and things like that. But sometimes people get too attached to these underperforming assets. They think, well, look, the market's been flat for 10 years, the mining downturn, etc. It'll come good eventually. And you've probably heard the saying 100 times. It's not costing me anything, to hold a property in a secondary or even worse location, and in the hope that it'll come good one day. So just being too attached to these underperforming properties and not moving them on and taking another step forward.
Interesting. It's not costing me anything, as you say, something I often hear. The context of it, though, is it's not costing them cash flow, but it is costing them opportunity cost because their money should be working hard for them. And as you said, treat it like a business. If you had a shop and it's now the time of the year that the winter stock's over, you wouldn't actually hold on to that winter stock until next year. You'd put a for sale sign out the front, you'd sell it at a discount, you'd buy new stock in that would make you money to get you through till next winter. So sometimes it's a bit like having an employee who isn't working as hard for you. It's a bit of a redundancy package you've got to pay to get rid of them so you can get a better employee. Much the same with your property investments. If you can only own 2 or 3, I want you to own the best 2 or 3 you can afford, ones that are working hard for you. So that's, again, as you said, emotion. That's part of it. You become emotionally attached because you invested so much getting involved in it, getting to buy it, and So once a year we recommend to our clients, and I guess it's an offer to anyone watching this video, they should sit down with somebody independent, somebody unbiased, somebody who's not emotionally involved, and say, how's your property performing? Now that doesn't necessarily mean you've got to sell it. Maybe there's things you can do to improve it. Maybe you can choose a new property manager. So is it just the time and it'll pick up? That doesn't mean you get rid of every property in Queensland, or is it in the wrong location? And a question I love asking, Brett, is, knowing what I know now, would I buy it again? That's always a telling question.
Absolutely, yeah, I find that as well, Michael. It's once they understand, that there are opportunities out there that are going to perform better, and that's a very good question to ask.
So people are thinking, well, I've missed out now. Maybe I should get the next hotspot. How often do you hear that?
Yeah, look, that's number 3 on my list, Michael. Absolutely. People are very speculative and, they're wanting they may have missed out in a certain area. So, look, where's the next area that's going to go? And then it's a very short-term focus.
Very, very much so, Brett, because if you see how people performed having chased the previous hotspots, while they had short-term capital growth and maybe higher rental returns, very few of the hotspots have panned out. I love keeping the old copies of API magazine and Your Investment Property magazine, and occasionally I skim through them. And interestingly, over the weekend, Brett, I looked at one's 2002, and somebody was making the prediction of Melbourne 2012, and boy did they get it wrong. And then I was reading some about the last decade as well, and everyone was talking about the Gladstones and the Port Hedlands, and it's interesting how those hotspotters got it so wrong. By the way, they've taken a lot of the stuff off their websites now. You can't see that. I've kept the hard copy magazines.
Yeah, absolutely. I've kept a few of those articles as well, especially from those Queensland resources towns where prices have obviously gone backwards quite considerably.
So what you're looking for is areas with multiple growth drivers, and in particular that is population growth, that's wages growth, and infrastructure. And Queensland's coming to a new stage of infrastructure spending. I see that as being one of the big drivers of wages growth, population and economic growth, Brett.
Most definitely, Michael. Look, we've got the exciting thing is it's actually our employment hubs that are expanding. So the Brisbane CBD is getting the Queen's Wharf project, which is a massive, I think it's 12 football fields worth of development, and also the airport as well. We're getting a second runway there and quite a large commercial precinct. So it's not only the infrastructure spending and things like that, but it's also creating jobs and creating these precincts that'll create jobs for much of our population.
What I see that doing, Brett, is taking over from the high-rise construction boom. Because if you think about it, Queensland did reasonably well during the mining boom, but a lot of the workers in the construction phase of the mining boom then went to the high-rise boom, and now approvals have cut back and there's few new projects coming out of the ground. Those workers have to have jobs somewhere, and your government is doing the right thing by investing in infrastructure, because that's going to give long-term benefits to the nation, long-term benefits to your state, but particularly it's going to give short-term jobs, which is going to create economic growth.
Yeah, absolutely, and that's been lacking for a long time, as you know, in Queensland, Michael. So, that's a big part of what's been missing in the last 5 to 10 years.
Okay, we're going through what investors have done wrong in Queensland. What's another thing that you're seeing people commonly do wrong?
Yeah, there's a lot of confusion because people focus very much on the short term. So they may need more cash flow, or they may need to recoup a loss and do something else. But there's no real long-term strategy. And I think, from my own point of view as well, that's something that really, pushed me forward, was actually having a long-term view and a long-term strategy, more importantly, to work towards, each year and adapt to as we go.
If I could give another point to that, Brett, they actually have to have the right strategy, because there's a number of different strategies. I mean, the two big ones are cash flow versus capital growth, and we very much believe in capital growth. Look, clearly you make your money in property in 4 ways: through capital growth, through rental returns, through manufactured capital growth, doing renovations or development, and through depreciation allowances. But if you think about it, in 10, 15 years' time, when you plan to retire from your properties portfolio, the majority of your asset base isn't going to be money you've saved. It's not going to be rent that you've received. It's not going to be the one-off boost that you've got buying a good property in a hotspot. It's going to be the long-term capital growth of your asset. And that's why paramount is actually getting the right location, the one that's going to outperform. Now, clearly, there's no hiding. This Brisbane property market has underperformed the other big capital cities. But I think we recognise that there's not one Brisbane property market. That's what we hear all the time. Brisbane has done that, Brisbane has done that. No, it hasn't. There are markets within markets. So how do you choose those markets that have outperformed, and how well have they done, Brett?
Yeah, look, the numbers have been really good. There's been a two-speed market. Obviously, apartments are underperforming, but the houses we're buying in superior locations where those drivers are, as you mentioned, Michael, the infrastructure, the employment growth. Then we break it down to wages and little things like school catchments, public transport's becoming more and more important, and lifestyle precincts. So if we're finding good opportunities in there, and they've performed very, very well. They've always performed well. They're proven performers. And there's always demand for those kinds of properties in those areas.
I think the other interesting thing is that they've been stable. So while they haven't boomed, they haven't slumped as much either. So during the difficult times, certainly parts of the Brisbane property market have been very consistent. In some way, they're the quiet achievers. And I know when we've seen some of our clients and seen some of their performance returns, they've quietly been very proud of how their properties have done.
Yeah, absolutely. And look, they're those strong owner-occupier locations, so they rarely go back. They just basically hold their levels, and then in good times they outperform quite strongly.
Okay, so we've gone through 4 of the common mistakes property investors make. Can you give me one more, please?
Yeah, look, everyone's trying to time the market, trying to get in at ground level and move forward. And again, Michael, it gets back to that short-term thinking and not having that long-term strategy. And I guess highlighting most of our points with diversification and the need to diversify into our bigger capital cities. And I've read some of your information as well with regards to the difference between buying at the bottom of the cycle and the top of the cycle in 15 or 20 years is not as great as everyone thinks, is it?
Well, the answer is you don't know the bottom of the cycle till after the cycle's happened, and all the experts don't know either. And if you take the philosophy that you should buy near the bottom with the concept of buying a bargain, that would mean that you shouldn't have bought in Melbourne or Sydney for the last 3 or 4 years because you would have missed the bottom, but look at what you've missed. Similarly, those who bought in Perth and Darwin in the last couple of years thinking it was near the bottom are still struggling. So really it comes down to getting the right location. When buying an investment, in my mind, there are 3 things. Your price, your budget, and that's set by the banks. Location, and we're not prepared to compromise on that. Or the type of property, so you buy the best location you can and then the best property in that location. But rather than getting the timing right, and I understand why people want to do that, Brett, I would actually just buy when the time is right for you personally. Because many years ago when I started, I read the philosophy of be fearful when others are greedy and greedy when others are fearful, and the concept of counter-cyclical investing. And I followed that, but I've learned and I've grown and I've matured, and I've recognised that successful investors seem to make money in all parts of the cycle, and unsuccessful investors, the average investor, does poorly in bad times and doesn't do much better in good times. So timing isn't that important, I agree with you. So Brett, there's lots more lessons investors can learn and learn from your years of experience and wisdom. If people want to get in contact with you to do that portfolio review I mentioned a couple of moments ago, or just understand and explore what their options are, how do they get in contact with you?
Yeah, sure, Michael. Obviously, we've got our website. You can contact the office and speak to the guys here, and I'll be more than happy to sit down and have a coffee and go through your portfolio or answer any specific questions you may have about the next steps or what you should do with your current portfolio, and we can really get into the detail and talk about those key drivers.
Well, thank you very much for your time, Brett. You've given us some interesting insights, and I guess what the take home I got is that if you can learn from other people's mistakes, you're less likely to make them yourself. And there are multiple markets around Australia, and even within the capital cities there are multiple markets, and there are some green shoots happening in the Brisbane market. It's not too late to get involved. Yeah,
absolutely, Michael. And as you said, it's more about time in the market rather than timing the market. And we can certainly get into those superior locations, as we talked about before. In a 15 or 20 year time period, you're going to create significantly more wealth.
No doubt about it. I remember when I first bought my first investment property for $18,000. Boy, that was expensive, and I had no idea how I was going to pay off the mortgage. But when you actually have a look at the long-term capital growth, it's made a huge, huge difference. Thanks for your time, Brett.
Thanks, Michael.